Dum dum da dum dum da da dum dum da dum 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 da dum dum da dum dum da dum 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 da dum dum da dum dum da dum 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 da dum dum da dum dum da dum 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 da 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 dum 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 dum.
Hello folks, and thanks for joining us. This video is going to talk about how the interest rates you pay on home mortgages, car loans, everything from mortgages and car loans to credit cards, personal loans. Also, it affects what interest rate you can expect when you go to your bank to get CDs, certificates of deposit, if you want to enter into a savings account. So it has practical application. But beyond that, what it also deals with is the health of the American economy, GDP, gross domestic product. You see, the Federal Reserve Bank, which is the central bank of the United States, finances the operations of the federal government. The federal government, if it runs a deficit or if it needs cash to run its operations, goes out into the marketplace, and often it borrows money to finance its operations or to finance the deficit. When it does so, the Federal Reserve Bank engages in open market operations. It also has other tools that affect interest rates as well. But the interrelationship between the Federal Reserve Bank and the operations of the federal government are key to what determines all interest rates. When the federal government goes out and sells U.S. Treasury securities, U.S. Treasury bills, notes, and bonds, that is theoretically the risk-free rate, and all other rates are priced according to some risk adjustment calculation that normally takes whatever the federal government pays and adds a risk premium to the rate that other borrowers in the open market pay on their securities, namely corporations or banks or whatever. So these rates that we're going to talk about today and how they're established are really the fundamental basis of how all other interest rates are determined. And just as importantly, it has everything to do with how much interest the federal government is going to pay on its deficits, and it has a direct effect on the health of the economy, gross domestic product. It has a direct effect not only on interest rates but also on inflation and the strength of the U.S. dollar. And we talk about other things that deal with the strength of the economy in our fiscal policy video and in our currency videos on the strength of the dollar, which also have an effect. But I want you to enjoy the video. I think you'll find it very informative, and thank you very much for joining us. Thanks for joining us. This is Dave Lentz, and this is the video that we're going to show in a few minutes, interspersed with one or two balance diet and exercise videos. Also, keep things sort of lively. We strive for balance intellectually and physically. But this is a money supply video that you're going to see here. And when I did it in the middle part of 2017, this is let's see, this is November the 24th, 2018. I decided that some of the stuff perhaps needs some preliminary explanation, and a lot of the discussion also is a little bit dependent on stuff that I talked about in the video on fiscal policy and jobs and gross domestic product, GDP. So I'm going to basically show you the slides that I prepared. I've tried to do this several different ways, and I think this may be the simplest, to try to give you a quick background. You can always slow down the video if you want to look at some of these a little more closely. So here goes. This is a preliminary explanation. Now at the end of the video, I also have the slides posted there. So if you can't see them during the video discussion because they're on the whiteboard, just wait to the end, and the slides are there as well for your more careful inspection. In all things economic, goods and services are produced and purchased, bought in the economy generally. And the amount of goods and services that are purchased and the price that it's paid are determined by supply and demand. This is fundamental to everything having to do with economics. And as you'll know, this is very important. It's crucial. Doesn't matter whether you're buying cars, food, clothes, real estate, or whatever. Everything depends on supply and demand curves. As prices on the demand side over here on your left, as prices go up, people want to buy less, so the quantity purchased, Q, goes down. As prices go down, people want to bargain, so they buy more, so Q goes up, the quantity purchased goes up. On the supply side, as prices go up, producers want to sell more and they'll produce more, so Q goes up. As prices go down, sellers are less happy, and so they will produce and sell less. So that's very fundamental to everything, and in fact it also affects the supply and demand curve, the aggregate supply and demand curve for the entire economy as well. Aggregate supply and aggregate demand. That's the aggregation, the addition of all goods and services in the economy, and aggregate supply is all the goods and services that are produced in the economy. Okay, this is a simple demand curve for all goods and services. Each and every one of them has a demand curve like this under most circumstances. As you can see, as prices are high, the Q is less, the quantity is less. As you go out here, there's more quantity. As prices go down, there's more quantity out here that's being bought and sold. That's why a demand curve is downward sloping like that. On the other hand, there's the supply curve. As prices go up, producers are going to supply more, and so as prices go up, there's more quantity down here. And as prices go down, there's less quantity. That's very fundamental. You'll see that in all supply and demand curves. Now this is very important. Now where supply and demand cross, this is a supply curve, that's a demand curve. Where they cross is called equilibrium. The equilibrium point determines the quantity that's bought and sold at a certain price, P. There's the quantity bought and sold, and there's the price that it's bought and sold at. All right. Now when we aggregate supply and demand for all goods and services in the economy, the demand and supply curves look exactly the same as they do for individual shoe, real estate, or whatever. It's just that you add them all together, and the demand curves, the aggregate demand curve just looks like a regular demand curve. Looks something like that. And I denoted AD for aggregate demand. Now the aggregate supply curve is also, it is in fact upward sloping. Now it has this little elbow, that is upward sloping right there, this part. But it slopes up steeper over here, and there's a reason for that, and it has to do with full employment, which has to do with, at full employment, you can't produce as much anymore. Even if you try to produce more, you really can't, and then you've got to pay higher and higher wages to try to get other employees to come and leave their current employment and come work for you. So this little elbow here at full employment, FE, is very important, but that's an aggregate supply curve. It is upward sloping even down here, but it just turns steeper right here. There you go. And then we talk about this in fiscal policy. AD is aggregate demand curve. The aggregate demand curve is determined by consumption, the desire for consumer expenditures, investment, the amount of investment that goes on in the economy. Government spending is G, and X is net exports. We talk about that at length in the fiscal policy video. Now in money supply, we're dealing mostly with the effects that the money supply has on interest rates. And in turn, okay, so money supply affects the level of interest rates, which is like the price or the cost for money. Okay, that's what interest rates are. You can view that as the price or the cost for money, for the use of money. Okay, and in turn, changes in interest rates affect I, the investment in the I in that formula. The C plus I, that I, it affects that. So changes in interest rates affect the I, and that's what we're going to focus on. Now, changes in interest rates may affect other things like consumer spending. I mean, people are less likely to want a mortgage or to buy a car if interest rates are high, for example. But we're just going to focus on investment, the desire of companies to invest in plant and equipment, and things of that nature in the economy. But it could have effects on some of those other elements as well. But for simplicity's sake, we're just going to talk about I in this video, investment. And since monetary policy affects investment, it also affects, very importantly, it has an effect on the amount of inflation, and also monetary policy and the money supply also affects, because it affects interest rates and inflation rates, it has an important effect on foreign exchange rates, the value of the dollar versus foreign currency, which in turn affects exports and imports, the NX in our fiscal formula, the NX. It also may affect the level of foreign investment and a few other things as well. Note that the demand curves for money, we merely replace for the P in our typical demand curve, we replace that with an I because the I is really the price or the cost that we pay for the money. You know, to borrow the money, for example, the interest rate, that you can look at that as the cost for that money. Okay, so instead of a P, we're dealing with I, which is interest rates. Okay, so that being the case, this is a typical demand curve for money. There's money right there. It's downwards. It just looks like any other demand curve, but it has the interest I up there instead of a P. The natural, okay. All right, now if we increase or decrease demand curves or aggregate demand curves, and we're going to increase or decrease supply curves in these videos, that's all we're doing, because they change the level of equilibrium, which changes the level of Q, which changes the price level or the interest rate level. Q in a lot of these instances ultimately reflects the value of gross domestic product. So the Q value really turns out in the end to be gross domestic product. But that's what we're doing there. And we're going to be shifting demand curves. And here's an example of a shift in a demand curve. On the left you see a demand curve going from 1 to 2. That's actually reflective of that would be an increase in demand. And the graph on the right is actually, we're not shifting demand curves, we're actually shifting supply curves. In these videos on monetary policy, the Fed sets the level of money supply. So the S here, in our case, for money supply is going to be a little bit atypical. It's going to have a tendency to be straight up and down or vertical, and we discuss why that is in the video. So it's the supply curve when you're talking about money is not necessarily as typical of normal supply curves. Okay, so basically we are just shifting aggregate demand and aggregate supply curves in these videos to determine GDP. And of course, we exercise our minds as well as our brains, we exercise our bodies as well as our minds here to seek balance. And so we're going to have, I think, 2 exercise videos. So anyway, I want to thank you for joining me, and hope to see you on the other side. Stay tuned. Thanks. Okay, folks, it is Thanksgiving Day 2018. It is 10:40 in the morning. I went to the gym at 9 o'clock this morning. I got back from the gym about an hour ago. I did manage to do 10 consecutive 195-pound pull downs, which are the equivalent of pull-ups, except it's on a weight machine. Very pleased with that. Even though it's far short of my record, I injured my forearm trying to do 225 pounds 10 times at the first part of September. And you'll see my forearm is bandaged a little bit, but I'm going to try to do a 3-minute plank here. I saw somewhere where somebody posted a 3-minute challenge to do a plank. My current record to do a plank is 2 minutes and 40 seconds. Not sure that this is the best time to try to do this, but what I find is I have a tendency to do personal bests when I really think I have no chance and I'm not really trying to do it. I have not been that successful in achieving records on film. I was able to do 80 push-ups last week. Oddly enough, I did them when I was at work. In any event, but I'm not going to try to do that today. So let's give this a shot. We'll see what happens. Incidentally, I weighed in last Saturday at 203 pounds, 0.4. 203.4 pounds. So hopefully this Saturday, in other words, in 2 days, my goal is to be at 201.6. If I had to guess, I'm probably about 202.5 pounds right now. All right, let's see what we can do here. Okay, here we go. All right, there's 1 minute. All right, there's the halfway mark. Two minutes. Thirty seconds. Fifteen seconds. Oh, oh, oh. 3 minutes, 3 seconds. Oh. So I'm very, very happy about that.
Dum dum da dum dum da da dum dum 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 da dum dum da dum dum da dum 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 da dum dum da dum dum da dum 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 da 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 dum 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 dum. Okay, folks, welcome to reasonandbalance.com. Thank you for joining us. We're going to go on with our discussion of monetary policy. We discussed fiscal policy last time. In the time allotted, we've got a lot of ground to cover. So without further ado, let's get going. Last time we discussed fiscal policy. We made the point that there are basically three main elements that are going to affect the level of economic activity in the United States, and that affects jobs and full employment. Fiscal policy, which is set by the House of Representatives, the Senate, and the President, and they have to agree on a budget, and they set the tax code and government spending, the all-important government spending, and the tax, not to minimize the tax code for sure. The second element of that is what we're going to talk about today is monetary policy, the Fed, which is the Federal Reserve Board, and more particularly, the Federal Reserve Board and its Open Market Committee. They are the governing body of the Federal Reserve Bank, which is the central bank of the United States. And then we also said that global factors also affect the level of economic activity in the United States, particularly NX, which is exports minus imports, that's net exports, currency exchange rates, which also affect exports and imports, and foreign investment, and a few other factors. Okay, all right, so moving right along, talking about monetary policy. The Fed is supposed to be independent, removed from the political tug of war that goes on. And the idea, one of the main reasons for that is it restricts the ability of government to inflate dollars to pay for huge government deficits.
That's just one advantage of having an independent Fed. They're trying to make monetary policy so that it's not a political football. It's supposed to, the supply of money is supposed to have some rational relation to a healthy level of economic activity. We're going to get to the issue of full employment in 1 minute. Well, let's talk briefly about that. The goal of the Federal Reserve Board is threefold basically. It's to maximize a sustainable level of employment. It's also, the Federal Reserve in setting monetary policy is also supposed to stabilize prices so that we don't have a lot of inflation, and it's supposed to moderate long-term interest rates. And we're going to see that the goal of maximum sustainable employment and fighting inflation are a little bit self-contradictory, and therein lies the tug of war that we're going to discuss at length today. Okay, so that's where we are. The Fed is, like I said, it's relatively independent. Its board of governors are nominated by the president, approved by the Senate, so you see there is a little bit of a political connection there. My understanding is that the Fed basically it's owned by its member banks, which is basically all your banks in your local community. There are a few exceptions that are under a slightly different banking system. But the banks in your region, your local community banks, and even some of the more national and international banks with more of a national presence are member banks of the Fed. And there are several regions, and my understanding, I'll have to double check, but I think you may want to check me on this, but I think the Fed, the member banks have to make an investment with the Fed. You have to, the Fed is allowed to make, I believe it's a small profit, a few percentage points. I think it might be 6, but anything over that goes back to the federal government. Okay, so that's my understanding. Let's see. What else do we need to discuss? Okay, in setting monetary policy of the Fed, they have 5 tools. The reserve requirement, the discount rate, the federal funds rate, the open market operations, and the auction facility. We're not going to really talk about the auction facility today. It really has to do with auctioning off the ability to get reserves with the Fed. So it's related to this reserve requirement. Banks, in order to make sure that the banking system is liquid and safe, all banks have to maintain a deposit, a reserve deposit with the Federal Reserve Bank. Okay, that's called the reserve requirement. The higher those reserves are, the less money the member banks, your local bank has to lend out, and that means they can make less profit if reserve requirements are higher. So if reserve requirements are higher, there's less money to lend, and that makes the money supply go down. So as reserve requirements go up, money supply goes down. As reserve requirements go down, money supply goes up because the local banks have more money to lend. Discount rates. Okay, the Fed will actually loan money to member banks to borrow money to meet reserve requirements. That's the discount rate they send. The federal funds rate is a rate that the Fed has, through technical means, some control over. That's the rate that member banks lend money to each other so that they can meet reserve requirements. The Fed pretty much sets that too, and that's the federal funds rate. Okay, so as all these things, the reserve requirement, the discount rate, and the federal funds rate, they're like a seesaw with a money supply. Think of a seesaw. As those reserve requirements go up, as the discount rate goes up, as the federal funds rate goes up, the money supply goes down. That's the nation's money, so the amount of money out there in the economy for us to transact business with. That's what MS is. All right. If the reserve requirement or the discount rate or the federal funds rate goes down, the money supply goes up. So everybody wants more money. The average person and the average business wants more money out there so
The banks will be easier to get money from for loans so that people can transact more business, buy more houses, buy more cars, and everything. So everybody likes a big money supply. But we're going to see here in a second how that's can be dangerous. All right. Okay, so these are the tools, and then probably the most important, perhaps, is the open market operations. Open market set by the Federal Open Market Committee, FOMC. All right, the Open Market Committee. Basically, this is let's basically just remember this. If the Federal Open Market Committee decides that they're going to buy U.S. Treasuries, that's bonds, notes, and Treasury bills issued by the federal government, Uncle Sam. If it goes out and buys those in the open market, that has a tendency to increase the money supply. So if the Fed buys treasuries, U.S. government treasuries issued by the federal government, that increases the money supply. If it goes out there and sells treasuries, that decreases the money supply. And here again, most of these transactions occur with what are known as primary dealers. And these are often, these transactions normally take place with commercial banks. They're really the other party. And again, it has to do with their ability to meet reserve requirements and how much money they have to lend and things of that nature. So if the Fed buys, it increases the money supply. If it sells treasuries, we're talking about bills, notes, and bonds issued by the federal government, Uncle Sam, that if it sells those securities, that has a tendency to decrease the money supply. Okay. All right. Now, how's all this stuff related? All right. Okay. We learned last time that gross domestic product, that's the health of the economy, all the goods and services produced by the American economy. If GDP is at that place where aggregate demand, AD means aggregate demand, where aggregate demand equals aggregate supply. And we discussed basically that like all economic activity that exists in the world, that supply and demand curves exist out there for virtually every type of transaction or every economic situation. And demand curves are downward sloping. As prices go up, there's less demand for goods and services. As prices go down, there's more demand for goods and services. Q is quantity, P is prices here. So for if this could be for socks, it could be for shoes, it could be for computers. As prices go down, there's more demand for it. On the other side, on supply situation, normally as prices go up, producers want to produce more because they can make more profit probably. And as prices go down, they want to produce less. So, technically a supply curve goes like that too. I've got it drawn slightly different here for another purpose that I'm going to get to in a minute. But basically, you can make this is a demand curve for any demand. You can make this the aggregate demand curve if you want it. Okay, so that's the aggregate demand curve. And this supply curve right here is eventually going to be the aggregate supply curve. And we'll notice this little elbow right here that starts right about here. And that just happens to be, and we'll get to it in a moment, at full employment. Okay, and as a matter of fact, let's relate to that right now. Okay. We learned from our discussion of fiscal policy, and we did a video on this, that aggregate demand, AD, equals consumer spending, C, plus investment spending, plus government spending, plus net exports minus imports. So that's a very important formula. Now where AD meets AS, this could be here. I'll tell you what. Let's not get there yet. I'm taking it right to the end, and I don't want to do that. Let's suppose
let's put the elbow out here. If this is AD, and this is aggregate supply for the entire nation, that's the aggregate supply of all goods and services, and that's the aggregate demand for goods and services, all goods and services. This is where GDP would be, right here. Okay, so that's how that works. That's what I mean by AD equals AS. It's right here. Okay, and all this would happen to be also. Let's move this. Okay, so this would happen. That's where the prices would be, and this is where the level of GDP would be, right here. And this is in dollars now. That's the level of it. Now, okay, very important point. That's demand now, and there's supply. Now, there's a very important factoid in supply, and we discussed it in fiscal policy. It's this elbow right here. Because this area right here, what we said that basically, in our discussion of fiscal policy, the economists think that something at or slightly below 5% unemployment is actually full employment. And the reason for that is the idea that some people are just coming or graduating from school, haven't found jobs. Some people have voluntarily left jobs. They may want to be a stay-at-home mom. They may want to just take a rest. They may want to, or they just want to go out and look for a different job. But there's always going to be a certain level of unemployment that you can't get rid of. And they come up with right now something 5% or slightly less than that. And that happens to be a very relevant figure. Now this is March the 18th. 2 days ago, the Fed increased one of these rates. I think they increased the federal funds rate. And what does that do? They increase the federal funds rate, that decreases the money supply. So that's what happened a couple days ago. All right. So let's see. All right. Well, anyway, since full employment is at 5%, here's the economic concept. Suppliers at that point at full employment may want to produce more. They may want to produce more even because they know they can get bigger prices for it, but the fact of the matter is, if everybody is fully employed and factories are going at full production, existing factories are going at full production, they can't produce anymore. And if they do try to produce more, what will happen is they'll have to go out and get additional workers, and who will already have jobs. They're going to have to bid higher prices to get the new workers. There's going to be high demand out there for other plant equipment, and they're going to have to acquiring these assets and that personnel for higher and higher prices. So what happens is you can't get further out on the quantity. Q is the quantity. So out here somewhere, this is where the GDP is, I'll put O, because the economy is overheated, and you're going to have, instead of prices being down here, prices are now going to be up here. And this area in here is called inflation. I'll put INF, inflation. So that's the concern. Okay. Okay, let's go back to the demand for money. All right. We see that the demand for money has a curve just like the aggregate demand curve. We are not talking about the aggregate demand curve right now. We're talking about, this is MDC, not AD. Notice up here, these are interest rates instead of prices, and this is still quantity, Q, in dollars now. Now we notice that for the demand for money, think of it as like the demand for cash. If interest rates are high and you can invest your money and get a lot of interest earnings off it, you don't want cash so much. So the demand is going to be less if interest rates are higher for use of cash as an asset. So, okay, and so think of it that way, or you can think of it as looking at this as sort of like if you're a borrower. You can sort of look at it that way in the sense that if interest rates are higher out there, you know, the thing of it is, you don't want to borrow quite so much than you do if interest rates are lower. And this demand curve is also affected by transactions demand, which again has to do with the level of the economy. And this is going to be how we're going to tie in the money demand curve with AD, aggregate demand. As the economy heats up, there's going to be more and more of a money demand curve. I mean, more and more quantity of money demanded. So I have interest rates right here, just I pulled them out of thin air. They could be any interest rates. As interest rates go down, we can see that the quantity demanded goes out, right? So this is going down. As interest rates go down, you're increasing, for example, as the money supply increases, okay, you're going to push the quantity of money demanded out, which means more money, right? Now, when the Fed sets the money supply, easing is when the money supply goes up. This is called easing. When money supply goes down, this is called tightening, okay? Now, when the money supply, the Fed sets the money supply, that's the amount. There's no demand curve. It's a set figure, and that's why that line is vertical, okay? As you ease, you can see you go from underemployment to full employment to overheated, UFO. That's what I've got up there. And if the economy is already overheated, you may want to tighten, the Fed may want to tighten, and go from O to F. You don't want to go to underemployment, so they would probably stop. So they would only do, if they did this, it would be a mistake right here, okay? This would be a mistake, and this would be a mistake, all right? Because theoretically what you want is full employment, because the Fed's goal is not only to see that there are jobs out there, but also not to have inflation. And we're going to see in a second that if they go from here to here, or from here to here, that it's going to be inflationary. I'm going to show you why in 1 second. All right, remember our aggregate demand curve. And let's focus on I for a second. Remember, that is investment spending, all right? This is now the investment demand curve. This is just a demand curve for one of these elements, okay? Just one of them, just the investment side. This is the investment demand curve. At higher interest rates, there's less demand for a company to buy new plant and equipment and to make investments, okay? Just like you're less likely to buy a home or a car at higher interest rates. Okay, but at lower interest rates, you're more likely to buy a car, and businesses are more likely to buy plant and equipment and expand. So, as interest rates go down, we see that there's more and more investment. You go from IU to IF to IO, okay? Now, here's the important effect in how the money supply curve works with aggregate demand. The money supply curve, when you shift the money supply, it has an effect on I. As interest rates go down, it increases investment and shifts the entire curve to the right. As interest rates go up, it makes the investment go down, that number becomes less, and that shifts the entire aggregate demand curve to the left. And it also has other effects, but we're just going to focus on I right now. The amount and the money supply is going to have an effect on interest rates, which would affect currency exchange rates, which may affect net exports, net imports, might affect home purchases, auto purchases, which may affect C, and may have something to do with whether the government decides to have deficits or not. So there may be other effects to shifts in the money, or changes in the money supply, but we're just going to focus on investment here. So anyway, let me get over here for a minute. So anyway, so what happens is because there's, like we said, there was a shift in the entire aggregate demand curve, okay, as interest rates go down, that it shifts right, okay, if there's easing, right? Because interest rates have gone down, right? What's going to happen is like, this is AD, this is the aggregate demand curve for underemployment. This is full employment, which is basically 5%, and this is overemployment. Let's see what happens. As you can see, if we were back here at aggregate, there's the aggregate supply curve. Here's the elbow in the curve. It's going like this, right? That's aggregate supply, right? Right there. Okay. There's the aggregate supply curve. And these are 3 aggregate demand curves. If we were back here before, like we've been for how many years, since 2007, 2008, you needed easing. You should have had easing, and they had quantitative easing and all that. They were trying to move the aggregate demand curve this way by doing a lot of quantitative easing to try to get it to full employment. Well, lo and behold, you know, a couple days ago, they must have finally figured, well, we've hit the goal of full employment, and we better watch out of what we do, because we don't want to get, because if we're right here and we, you know, and we continue easing up on the money, we may end up here, which would put, if this is prices at full employment, these are prices at underemployment, and this is prices overheated, okay? Actually, they probably thought that we were probably somewhere up in here, or that we were headed in that direction. But you see right here, here's the problem. To go from PU to PF in prices and go from here to here, you only have this much of an increase in prices. And you get this much of an increase in GDP. You go GDP, underemployment, GDP, full employment, and then the problem here is you get overheated GDP. And this area right here is very little, but you're getting this huge amount of price increase. And this is exactly what, because this elbow up gets quite steep the further out you are and having too much money out there. Let's see, what else do we need to discuss? I think that pretty much handles what we came here to discuss today. And I want to thank everybody for joining us at reasonandbalance.com, and we'll see you next time. Thanks.
Bum 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 ba-dum, 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 bum 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 ba-dum. Dum dum da dum dum da da dum dum da dum 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 da 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 dum 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 da 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 dum 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 dum. Bum 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 ba-dum, 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 bum 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 ba-dum. Dum dum da dum dum da da dum dum da dum da dum dum da dum dum da dum dum da dum 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 da dum dum da dum dum da dum da dum dum da dum dum da dum dum da dum 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 da 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 dum 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 dum. Okay, this is Dave Lentz again, and let's see, it's 9:42, Thanksgiving evening 2018. I think it's, oh geez, I don't know. Anyways, Thanksgiving evening. I did a plank several hours ago, 3 minutes, which was a new record for me, so I sort of hesitate to try this, but I'm going to go ahead and record it and see how many push-ups I can do. Been several hours since then, but I also went to the gym this morning, so I like to try to break up my workouts a little bit, especially the plank and push-ups from the rest of my gym routine. I find that even though it's a little easier on me, for some reason it makes going to the gym less tedious, and I don't get frustrated or bored or just exhausted doing it, so I break it up a little bit like this, so that this is more of a breakup than I typically do. Like I said, I did a 3-minute plank several hours ago, which was a record for me, and so I gave myself a little more of a rest in between exercises than I typically do. So let's see what we can do here. As they always say, a clean workout area is a happy workout area. All right, here we go. 1, 2, 3, 4, 5. Well, not exactly the 80 that I had hoped for, but really, all considered, I'll take a 75. And be happy with it. Scheduled for a 5-mile run tomorrow. Let me just say, I didn't have any gravy today with my turkey. No potatoes. I had lots of turkey though, but I still think, well, in fact I know, it's 9:45, and as we speak I'm sitting right at 1,750 calories for the day. So considering that it is Thanksgiving, I'll chalk today up as a success, and I'll see you next time. Thanks. Beep bop boop bop boop bop boop da bottom bum. Beep bop boop bop boop beep boop bop bottom bum. Boop boop bop boop bottom bum. Boop boop bop boop bottom bum da dum da dum da dum bottom bum. Beep bop boop bop boop bop boop da bottom bum. Beep bop boop bop boop beep boop bop bottom bum.